Hello, this is Alexander Sebastian with Parents as Partners, and I'm addressing you today on a topic that's close to everybody's hearts, and that's finances. You know, as expats, we have a pretty sweet deal usually. The companies pay for our housing, our utilities, they pay for our vacation trips, our kids' education, tuition in the international schools. Usually the salary is pretty good. So overall it's a pretty sweet deal. However, things can go sour very quickly in the expat world. Companies close up, they're bought up by other people, there's a change in personnel, so we don't have the security that people back in our home countries have, and of course there's no unions or anything to protect us. We're pretty much at the whim of our employers. So on top of that, often our employers don't contribute to the national pension fund or to a private pension fund. So we're pretty much on our own as far as taking care of our future financial stability. So that's what we're dealing with today. I'm going to talk to you a little bit about the options and the risks, and hopefully this will give you some information to set you up on a more stable basis for planning your future. Now we're going to talk about 5 things today, and I'm going to read these off my list. We're going to talk about your needs first of all. If you're in the baby boomer generation, then the possibility of you living to be 100 are 1 in 8, which is probably much different from your parents. And if you're a millennial, the possibilities are 1 in 5 that you're going to live to be 100. So you've got a long time to plan for. Employers are, in some countries, as for example in Holland, they're always trying to get rid of the older employees as fast as they can so they can hire new employees in. And this might be true, especially if you're in the technical aspects of in your expat job. The new people come in, of course they cost the company less, they're hungry, and they have the latest from their universities training. So as we get older, if we're not sharpening the saw all the time and keeping our skills up, we might find the pink slip in our mailbox very unexpectedly, and we might have a lot of years ahead of us yet. So we have to look at what our needs are. Our children, are they going to be out of the house by that time? And does that mean at university with tuition you can count anywhere between $25,000 and $40,000 or $50,000 a year, if you count in tuition, books, transportation, living expenses, etc. So that really adds up very quickly. How many kids do you have? Huh? So you have to think about that. If your kids will already be out of whatever they're going to do after high school, and I'm not pushing a university, if they can set up their own business or learn some kind of skill in a job they like, good on them, huh? But anyway, you have to think about what your needs are going to be once you do retire at 55, 60, 62, 65, 66, and if you can last till 70 to get full pension from the American Social Security anyway, good on you. So we're going to look at your needs, that's number 1. Then we're going to look at your assets, what you have put aside, what kind of pension plans do you have, what kind of real estate do you own, are you invested in the stock market or bonds? And so second one is going to be looking at the assets. We'll do an audit on that. Third one, we're going to look at your risk level. Of course, you know, with inflation, if you just keep that money in the bank, you'll end up with less every year. So how much are you willing to risk in high-risk investments, and how much do you want to keep in safer investments such as bonds, annuities, life insurance programs, or in real estate? So that'll be the third one, is the risk level. And then we're going to look at a different type of investment plans, what you can do with your money to be sure that whatever comes up, you're going to have some backup scheme. If it goes well, of course everybody loves those 12, 15% years when the stock market goes up, but we all know what happened just 10 years ago, or 12 years ago now, in 2008, and this is cyclical, so it's going to happen again. So you always want to keep some safe eggs in a basket. And then, so that's number 4, we're going to look at your plan. And number 5, we're going to look at what you need to do to implement that plan to be sure that you keep putting something in your savings every year. Okay, so let's go back to the top. We talked a little bit about your needs. If you're married, is your partner working? Are you the only income? Does your company have a pension? How many are going to be? How many are you going to be supporting if you would lose your job tomorrow? And how many people are you going to supporting if you retire at, let's say, 65, 66 now? According to CNN, retired people need about 70% of their after-tax revenue. So that seems a little high to me because in my case anyway, my children, well, I still have my children. I'm retired already, and I still have both my children at home. But one is leaving this year, and unless he goes to university, but we've already got that money put aside. So yeah, you have to get, what are the demands that are going to be made on you and your finances once you don't have that weekly or monthly paycheck coming in? Do you have a house also? The biggest expense is your housing. There's lots of options on housing. And of course, you might be thinking about downsizing once the children leave the nest. The key is always to stay within your means and to spend a little less than what your revenue is. So if you have revenue coming in, downsize is the key to comfort and feeling of security once you retire. Okay, so taking an audit of what your needs are, and then what are your assets. Of course, you have your house, hopefully, or some property. If not, maybe you've invested in a real estate investment trust, what they call a REIT, which is you've invested in other people's houses, or commercial property, or industrial property, or hotels. These REITs are trust funds in which you can buy a share, just like a share in any company, and the main assets of that fund is real estate, is property. You can buy all mortgages, you can buy residential mortgages, or you can buy in commercial, or a mixture across the board. Now with these ETFs, these traded funds, you can buy a basket of companies, shares on the stock market through a broker, and now the brokers are getting cheaper and cheaper. And now, for example, if you go with TD, the old Scott trade, which is now TD America, you pay $6.95 for a trade, or Charles Schwab is probably about the same. And Interactive Brokers, I've heard their advertisements, they're down to $2.50 a trade. So you don't have to make too much money to buy and sell and still make a profit on that. So if you don't know anything about the stock market, there's tons of information on it, and you can get in with a very limited $1,000. I think you can get in, and you can even buy penny stocks and just get your feet wet. So you can look at the, as I said, these ETFs. You can buy them in different sectors, in growth sectors, which are companies that reinvest most of their money, and they're looking to increase their market share, usually larger companies. Or you can get in value companies, ETFs, and these ETFs look for companies whose value, whose prices have fallen, and they think that these companies will go back up and their stocks will increase more than the average. Or you can go for the average of the whole stock market and get an ETF on the index, an index fund that just follows the general index of this, for example, the New York Stock Exchange, or you can do it for other countries' stock exchange as well. You can buy a global ETF, so then you're really diversifying your risk over a large global area. And if something goes south, for example, in one country and their stock market, you're still buoyed up by the stock markets on the global economy. You can buy ETFs in emerging markets. You can buy ETFs in specific countries. For example, Turkey has a TUR fund that holds stocks in the major companies in Turkey. China or the Far East. So there's whatever your interests are, wherever you think the risks are going to be the least for the largest return. It's amazing all the different funds there are, and it's fun looking at them, and you could spend a lot of time. But the main key is, especially if you're in retirement age, is to spread your risk out geographically and over different type of funds. For example, funds that are in industry, or funds that are in medical, or in agricultural, or in transportation, or utilities. There are so many different areas. So you want to spread that money around geographically and by sector. And also real estate. So there's three right there. Also, you might be interested in having some money in Forex, foreign exchange. Being an expat, you probably have more than one bank account in different countries, and it's probably good to keep some money in those different accounts, because if for example, say the US dollar goes down, at least you won't have all your assets going down. If you have RMB account, which has gone down last year, but if the US dollar goes down, the RMB account will go up. So, or you can trade in Forex. There are ETFs that allow you to trade, the British pound and the euro, in a lot of movement going there. So you can put a little money in there and let them, these are professional managers. You don't have to manage it yourself. You just have to trade the fund, buy the fund, and let these professional managers make you some money, hopefully. So there's also precious metals. Gold has been going up since January 2019. That's another. You can buy precious metal funds, or you can buy the gold in several different ways. You can buy bullion, gold, the metal, and put it in a safety deposit vault in your bank. Of course, you have to pay a monthly fee, but okay, that's just part of the maintenance fee. You can buy bullion that's held in a trust fund. You actually own part of those assets in bullion that are held in that bank vault. That's pretty secure. You can buy silver the same way, silver fund, platinum, palladium. You can, or you can buy an ETF precious metal fund. You can also buy gold mines stock. There's GTX and GTXJ, which is junior gold metal mining companies, and so these are their value of these companies is based on the assets that are in the ground and what it costs to finally refine their metal and bring it out, bring the ore out and then refine it down. So this is a very interesting area to get in as well, and it can be a lot of fluctuation on that. So a lot of different ways to own that metal. But the message is, don't put all your eggs in one basket. Spread it out between maybe a little bit of Forex, maybe some bonds. Now bonds are not what they used to be. They go up and down too, just like the stock market. But maybe you want some bonds, and you want some real estate funds, you want an index fund on the general stock market. Maybe you want to take a risk, whatever you're going to invest, take 10% and put it in a high risk growth fund. That's possible too. So hopefully to make a little bit extra on there. I've been in the stock market since the 80s. I can't say I've made a lot of money. I cannot say I made a lot of money, but I do okay. And I figure if I average out 5% a year, then it's okay. Some years I've made in the 20s. Some years I've lost money. But I'm happy if I make 5% on that. And if you buy a guaranteed deposit certificate, they're only going to pay you between 2.5, maybe 3 if you're lucky, percent on that, which is just over inflation. So I have some of those, and that's in case the worst scenario, I know I will have access to that money, and I put it in spread it out every 4 months, so that every 4 months I've got a slice of that, one tranche of that will be available to me without a penalty. I can take it out, and that's that's guaranteed that I'm going to get that. It's guaranteed by the federal government as well. So there's lots of ways to invest your money, and you want to keep some cash. Always, my personal point of view is I like to feel like I have 6 months cash sitting in the bank, so that if whatever happens, especially when you're overseas, you never know what's going to happen. So I like to have 6 months cash, that if the bottom drops out of things here, I can get out of here with my family, and we can go someplace, and we have 6 months to get back on our feet. And so that's you need that, and if you feel comfortable. Okay, so that's looking at the different assets you might have. Now your risk level. You don't want to put all your money in one area, and you don't want to put at a high risk if you're not comfortable with risk. You don't want to be worrying about this at night. You want to spend maybe an hour in every morning or every couple of mornings looking at your investments, playing around, always getting more information, getting the feel of what's happening. And as I said, I've been in the market since '80. I don't think anybody really knows what's happening. All these gurus, I don't think they know more than what I know. They lose money, they make money. When they make money, you hear about it. When you lose money, you never hear about it. So I think you have to really trust yourself. I used to subscribe to these investment letters. I followed the stock market, what everybody was saying. I was investing a lot of time. Over that 30-year period, there was no constancy in what people were telling me. They're no better off guessing at what's going to happen than I am. So educate yourself, trust yourself, get in a little bit, and then as you get your feet wet and know what's happening, you can kind of feel the trends. But yeah, it's no sure thing, that's for sure. Okay, so once you get you don't want to be laying up at night. So back to the risk level. You don't want to be laying in bed at night wondering what's going to happen over the night, and fearing that you're going to have to change your lifestyle because of what happened, because of what some politician did, or a war broke out here, or the dollar dropped out, or something. You don't want to worry about that. Put your money in, spread it out, and you'll probably be okay. But don't worry about it. And if you're worrying about it, you don't belong in the stock market, and it's not worth it. Okay, so and your risk level will also depend on your age and your health. We haven't spoken about health, but that's part of the in your audit. If your health, if you happen to be a smoker, or if you have a history of illness in your family, genetically transferable illnesses, then you better have a backup and plan for that later on, because health can, as you know, they're not looking out for you there. They're looking out for investors in the investors in the health market. That's who are making the money, huh? Okay, so that's risk level. Now, what are your plan options? Okay, we talked about several different types of investments. What we didn't talk about is annuities. You can buy an annuity, which is a contract with a financial institution in which you contribute money regularly, and then it's like a pension. When you reach a certain age, then they start paying you back, and it can be for your life, or it can have a term on it, a fixed date when the last payment will be made. But annuity usually goes for your life. And it's nice to have regular revenue coming in. Actually, my advice is spread your sources of revenue around. If you can get Social Security, great. If you have if you can get a house and rent it, 1 or 2 houses out, whatever you're comfortable with, and make a little money on that, that's another safety zone. And an annuity is another one. Investment in the stock market is another one. Guaranteed A certificate of deposit is another one. But I strongly advise you spread your sources of revenue out because things change and you don't want to be dependent on any one source. Okay, now you need a plan. Well, if you don't already have money put aside, and if it's sitting in the bank, it's not doing you any good there, and they're paying you such a meager interest now. You're losing money. So you need to sit down, and there's lots of information on the internet how to divide your assets up. If you're stable and you're living in an area that you know about, I strongly suggest at least get 1 or 2 houses with revenue, or the real estate investment trust. You'll make more if you have your own home, though, that you're renting out, and especially if you know something about repairs. But that's you have to be careful where you're buying, of course, and think about the market. But it's a good source of revenue that comes in regularly every month. The other thing is to try to put 10% away of your, depending on your age. If you're up in the 50s, you need to be putting more than 10% in now. When you start out in the 20s or 30s, 10% of all your gross revenue will set you up nicely for when you retire. But if in your 50s, you have to think about putting in 25, 30% away, especially if you don't have any Social Security or pension coming in. So start building that up. If you're already getting close to the age of retirement and you don't have much money put away, still, I believe you can still have a good life just by living within your means. You're going to have to change your lifestyle from spending all that money that you're making now, but there's lots of ways to do it. An RV is a great way. You can pick up a used RV that's comfortable to live in for the next 20 years for $20,000, and there you've got a nice house over your head with all the furnishings, and on top of it you can move around. And we lived in an RV for a year. It's a great way of living. There's also boats. You can get a boat for 20 to 30,000 US dollars, and that's a good way of living. Don't forget the intentional communities, what we used to call the communes. You can join those if you have a skill to contribute, and it's nice to have other people around. So there's lots of ways. Don't count on your children, and unless you're Asian, and even if you're Asian, probably your children are not going to be interested in taking. That's over. That boat has sailed. The children are not taking care of their parents here in Asia, and certainly not in the Western world. So you can have a good life, whatever your revenue is. Just live within the means of it. And if you have a good partner who sees the important things of life, the sun coming up in the morning and the flowers, and doesn't worry and keeps the right attitude, you can have a good life. Yeah.